Okay, welcome everybody to Finance 444. This is week 2. You made it to week 2. Um, we lost an hour this week, so I'm sure you're all tired and ready to go to bed. But hopefully we'll make it interesting tonight. We'll talk a little bit about taxes. We'll talk a little bit about short-term savings and cash management. Those are chapters 3 and 4 from the ebook. And then we'll get you ready for the test, which is the most important thing we can do tonight. The test this week is 50 questions. It's a midterm test. It's worth twice as much as last week's test, which, by the way, most of you got a B or an A on last week's test, so great job. Most everybody did an excellent job on last week's test. The material must have been very easy to find, and information must have been pretty straightforward. Like I say, most of you got a B or an A, which means that you probably felt like the test was pretty straightforward, pretty easy. So this week should be more of the same format of a test, mostly true, false, true, false, and multiple choice. I don't think there are any matching questions again this week, Michelle, so you're in good shape. And yes, I agree with you, Jack. It's a lot more straightforward when you've got chapters to refer to, right? Instead of just a huge, vast amount of information like we had in the Series 7 stuff from 443. By the way, I've given that feedback to the school about the last course, 443, and hopefully they adjust that going forward for the sake of future participants. Okay, so that's this week's test. Midterm, like I mentioned, should give you a couple hours to do it. 50 questions, mostly true, false, and multiple choice. As far as last week is concerned, I mentioned the test went well. I thought the discussion board looked good. I haven't yet graded it. I've graded all the assignments already. Most of you did a great job on the assignment. There were a few of you who either didn't get it in, or a few of you who unfortunately I couldn't give full credit to because either it was well short of the 2-page requirement that we had changed it to. The instructions called for at least 3 pages. You'll recall during the session we said make sure there's at least 2 pages. Some of you, wrote just a page or a page and a half, and unfortunately, if instructions say one thing, I can't give you full credit. Even if you write a great paper, I can't give you full credit if you don't meet the writing requirement. This week we're going to do the same thing, 2 pages instead of 3 to 5. So if you're here during the session, you've got a leg up on that. The assignment is a financial planning question again. There's a little bit more to it than there was last week. There's a couple different parts. Let me just tell you, it's on page 151. So it's number 9 on page 151. And basically, it's a case study of a situation where, some people make some money. They give you the income. They talk about how much they have in investments. And then some of the questions ask about how much they should have in savings or emergency funding. And so, if you just went through A, B, and C on number 9 and just gave a one-word answer or one-line answer, you'd be well short, of course, of the 2-page requirement. So what does that mean? It means that we need to do some research. It means that we need to find out what the book has to actually say about how much should be in an emergency fund, or what you should do with short-term investments or liquid investments as far as savings for reserves. So this is important to get that data, to look through online like many of you did last week and find other opinions, right? So what you'll find when it comes to financial planning is that every site that you go to is going to be a little bit different as far as their opinion on what you should or shouldn't do. Just as an example this week on cash management, when we talk about reserves and emergency fund planning, as a general rule of thumb, most financial advisors would have you have 3 to 12 months worth of expenses in savings for emergency reserves. But as I do financial planning for people, that 3 to 12 months is a nice benchmark, or a nice starting place. But a lot of people don't even need that, or they need a lot more, just depending on what their life situation is, what kind of one-off expenses may be coming up for them, how good their insurance is, whether or not their income is guaranteed or not guaranteed. So if somebody's got income, for example, through Social Security, that's different than if they're self-employed as a realtor. A realtor might go 2 or 3 months without one home sale, right, and be without income. Somebody on Social Security is going to get that monthly check every single month, no fail. Okay, so there's a lot of different things that can come into play for how much people should have in reserves. There are some general, rules, and you can look those up and do some research on that. And then you can give me some feedback on what your thoughts are based on their particular situation or the data that they give you for this problem. Anyway, there's lots of different ways that you can go about creating a couple pages worth of writing. So it's not a valid excuse to say, well, I just didn't know what to write for 2 pages. We've talked about a lot of different things that you could go with, and there's a lot of different perspectives you can take on emergency fund planning or reserve planning, and then the types of products that you could invest in or save with, through emergency fund planning. And so there's lots of different, like I say, directions and perspectives and opinions that you could provide on this one case study, which is number 9, page 151, after chapter 4 in the book. Okay? All right. I did have a couple of questions early last week about the ebook. Michelle, Jack, I assume you were able to get into the ebook, but the easiest way I know to tell you to get into the ebook is just to go to the main page, go into week 1 or week 2, one of those links, and then just scroll up on the page, right? Just scroll up on the page and it'll say something to the effect of, let me just look at it so I can give you exactly what it says. I'm sure most of you were able to get in, but just in case there are a few of you who don't see an ebook link, and so you don't know what to do, if you click on week 1, week 2, week 3, one of those links on the main page, and then when you get to the next page, just scroll up, and you'll see a link called Course Home, and under that it's got a bunch of different links. One of them is the VitalSource ebook link. VitalSource ebook link. So just click on that. It takes you right to the ebook. Okay, and then you can go to the table of contents once you're there. Go to page 151. Should be pretty straightforward. So I think most of you got in. Sounds like Jack, you and Michelle got in just fine. But I did have a few questions early on in the week on where's the book, or where's the ebook, and that's how you can find it. Okay. So I will have discussion boards graded by tomorrow. Probably get them graded tonight. If not tonight, first thing in the morning. As I've told you in 443, I always get the grading done by noon on Tuesday, which is a day early as far as the school is concerned, but that just gives me some time, cushion to work with just in case something dramatic comes up. But most times you'll have it. Last mod, for example, every single week we got everything done and graded, usually by Monday night, but sometimes by Tuesday morning first thing. And then, usually I'll give you feedback on how you can resubmit assignments or things that you can do on the discussion board to edit or change or add posts in order to get additional credit. Not nearly enough of you took advantage of that last mod. Keep that in mind. When you see my grading feedback, know that it's an encouragement, in essence, an encouragement to have you do some additional effort if you don't get full credit. Now, that's not true for late work. If you're late and I've docked 10 or 20 points because it's late, unfortunately, we can't make that up. But if you turn your assignment in on time and it's short and you don't get full credit, you're always welcome to resubmit, accomplish the whatever it was that you missed out on the first time through. And if you resubmit, I'll give you additional points and get you closer to full credit. Okay? All right. Jack, Michelle, any questions about last week, any of the material we covered? Any of the assignment assessment discussion board, anything like that we can look at? Okay. Michelle, you and I had a conversation about some of the work going forward that was locked out and everything like that. Everything should now be open to you as far as working ahead and things like that. I just hadn't been able to review the assignments, when we first spoke last week, and so everything's open. So if you get some extra time or have everything done and happen to be able to work ahead, that's phenomenal. I'd encourage you to, and everything's open and should be available for you. Okay? All right. So as I mentioned earlier, we've got 2 chapters we're covering tonight. One of them is chapter 3 about taxes, and one of them is about chapter 4, which is about cash management. Yes, Michelle, I have no preference on when you post as far as when I post versus you. In fact, a lot of professors will say that, the discussion board can't be participated on until they participate. I don't have any preference for that. So you're welcome to get in and post as soon as it's open and available. Okay, so pretty timely discussion tonight as far as the session is concerned. Tax time, who knows when the tax date is for filing? What's the deadline this year? What's the deadline every year for taxes? Okay, kind of a trick question. This year, the deadline for filing taxes has been extended by a little bit. Whenever April 15th is on a weekend or close to a weekend, they give you till that following Monday. So this year, if I'm not mistaken, that is the case. Let me just look here. Yeah, so this year, taxes are due actually on April 18th, but you're right, traditionally in years past, obviously April 15th is that date that people know is tax day, right? And that's when your personal taxes are due. Corporations have different deadlines. Farms have to get their taxes in. If you're in farming, you have to get your taxes done by March 15th. There's all kinds of different exceptions. Some people have different fiscal years, and so they do taxes at a different time. Other people do what's called an extension, and they basically file their taxes late every year, and they have up until September 15th or October 15th, depending on whether or not you're a corporation or an individual, if you filed an extension and pay interest penalties basically on your return. So, Michelle, it sounds like you've got some kind of trick that you have as far as waiting till the last minute to file. You'd have to let me in on that, because as far as I'm concerned, as far as the CPAs that I talk to, if you're getting money back, it's in your best interest to file sooner, because it's not going to change how fast you file. But if you're having to pay, it makes sense to hold on to your money as long as possible. And so if you're having to write a check out to the IRS or to your state, it would make sense to wait all the way until the end, right? Because then you can get interest on your money and have time value of money on your side until you have to file. Okay? All right, so let's go over a couple different things as far as taxes are concerned. I think you'll find some of this interesting, informative. Many of you probably have already filed. Knowing this stuff doesn't mean that you're going to be an H&R Block person or a Liberty Tax person on the corner. Okay? So, it's not about becoming a tax professional. What it is if, all of us have to file taxes. And because of that, it makes sense to have some basic information so that when you're doing that, you can either cross-check your CPA or cross-check who you're using, whoever it is on the corner, or even TurboTax if you're using it, and walking through it that way, or even if you're manually filing on paper. Those are all things that knowing some basics about taxes might help you. You definitely do get more discounts potentially as a single parent, Michelle. It kind of depends, though. I mean, for example, there are a lot of tax issues actually that are beneficial for somebody who can file jointly. And so, one of the reasons why, over the years that the LGBT community was so anxious to have the ability to be married is so that they could file jointly and have, the tax benefits associated with filing jointly instead of filing individually. Just as a complete aside to tonight's discussion. But that's just something to joint filing actually has some benefits. Now, individually filing, if you have children, for example, you have child credits, you have different benefits and deductions and credits that come based on going to school. There's all kinds of different things, Michelle, that you're probably getting as a benefit based on being a single parent as well. Interesting. Well, I don't know if maybe your situation changed a little bit that year, Michelle, but in a normal year, if tax laws don't change, if you filed January 1st, right, of a year for the prior year, it should be the same as if you waited all the way till April 15th. Because the tax law shouldn't change for the prior year, right, between the time that filings can be done between January 1st and April 15th. Might have just been a coincidence. I'm not 100%, I'm not telling you it wasn't a coincidence, but it might have been a coincidence that you had that happen. As far as 1 year filing early, maybe the tax situation that year was different, and maybe the rules did change from year to year, because they do change every year. They usually just don't change, and things don't change between filing in January or February versus filing in March or April. So I don't know exactly what happened, but like I say, for a normal situation, shouldn't be any difference between filing early or filing late, other than if you wait past April 15th, you're going to have to pay some penalties and fees, right? So we want to make sure and get everything filed in by April 15th. All right. So, of course, the IRS is the Internal Revenue Service. They're the ones that enforce tax payment. They're the ones that can actually put us in jail, right, if we don't pay taxes. So, tax... well, and we're going to be talking about this on the discussion board, right, this week, difference between avoidance, okay, and the difference between basically breaking the law. So most of us are trying to avoid as much tax as possible, but we're doing it legally. But there are many people and there have been famous people over the years that have done this as well, that don't pay taxes or report things that are a lie on their taxes just to get out of doing it, just to get out of paying. And at some point, that'll catch up to them, right? The IRS will come after them. They'll either be put in jail for fraudulently just absolutely lying and trying to deceive, or they'll have to pay, penalties and fees over time and trying to get it resolved. So, Michelle, that as far as income taxes are concerned, that's true. Okay, so as far as income taxes, if you make very, very little, you're probably not having to pay anything in tax as far as income taxes are concerned. You still will pay probably payroll taxes for Social Security and Medicare. You still will pay sales taxes, right? When you buy and sell anything, you'll still probably pay property taxes. You'll still probably have different surcharges on things like gasoline, cigarettes, stuff like that. Those are a tax. There's taxes on all those things as well. So even though you might not pay income taxes, Michelle, per se, you might not have to write out a check to the federal government. You might actually get money back, even though you didn't even pay any money in, through credits and things like that. But even though you don't do any of that, you still are probably paying taxes in different ways. Even if you were to say, well, I don't do any of those things either. I don't own property, so I don't pay property taxes. Well, the only reason you're paying the rent amount that you are is because your landlord, the person who owns the property, has to pay the taxes, and they're going to collect enough from you, right, so that they can pay taxes. So indirectly, you're paying taxes no matter what. No matter how much you make or how little you make, you're probably paying taxes. Most all of us have to buy gas. There's a gas tax in every single state, if I'm not mistaken. There's sales taxes in almost every single state. There are property taxes. So yes, it's true, Michelle, regarding income taxes, that if you have a very low income, you may not have to pay anything. In fact, you may get money back even though you didn't pay anything. But most Americans, even if they get a return, so sometimes, Michelle, I'll be talking to somebody about taxes and they'll say, well, I get a return every year. That means I don't have to pay anything, right? And while it might be true that you got a return so you didn't have to pay anything come tax time, what it probably means is that you were paying taxes all throughout the year through your employer. So Jack, Michelle, I don't know if you've looked at a paycheck or a pay stub lately, but when you look at it, you're going to see payroll taxes as far as Social Security, Medicare, Medicaid, come out. Okay, and that's about 7 and almost 8% that comes out of your paycheck that goes to Social Security and Medicare, Medicaid. And then on top of that, you pay federal and state income taxes through each one of your paychecks. And usually when people get a return, it's just a return of the taxes that they paid, right? Either a return of all of the taxes they paid if they make a little, or just a portion of the taxes that they paid. Okay, does that clarify that a little bit, Michelle? Taxes are pretty complex, because there's so many different types of taxes, and we're going to talk about a couple different ones tonight. But income taxes are the ones that everybody's thinking of because that's what's due in April, right? Our federal and state income taxes. But there are a lot more taxes that occur. And as this slide says, the average American family pays more than a third of its gross income in various taxes. The reason it says various is because there's all kinds of different taxes going on. It's not just income taxes. I've got clients that pay well over half of their income in taxes. So when you look at just federal and state taxes between the two, it can get up over 50% for people if they make a lot of money. Okay, and that's what we refer to as a progressive tax structure. The more income that you make, the more that you pay. So this slide is just referring to the progressive tax structure. Food tax, by the way, is a regressive tax structure, meaning the less that you make, the more that tax is as a percentage of your income. So if I make $500,000 a year, I might buy a lot of food, but on a relative basis, the person that makes $30,000 a year pays much more of their income towards food, right? Just on a percentage basis. Not that they spend more on food, but just as a percentage of their income, because their income's low, at 30,000, as a percentage, they buy more food as a percentage of their income. Because of that, food taxes are regressive tax, meaning the poorest pay more as a percentage of their income than the richest. So progressive taxes are ones where rich people pay more. Regressive taxes are ones where poor people pay more as a percentage. And so regressive taxes, as you can imagine, are very unpopular. Politicians try to get rid of regressive taxes or change them. In many states, food doesn't have any tax on it, and it's because of that. Yeah, and Michelle, to your point, it's very difficult for someone who makes that kind of money in a W-2. Now, if they were self-employed or had their own business, there are lots of things that we can do to lower their tax situation. But if you're getting a W-2 for, let's say, $500,000 a year, there's almost nothing you can do with that W-2 to pay less in tax. That's just what you're going to pay. Now, there are all kinds of strategies as a financial planner that I help them with to maximize deductions, credits, anything we can find from a tax planning standpoint. But even after all of that, even after helping them the best we can, they still end up being really high as far as the tax bracket. And it's no wonder that those folks end up really frustrated. As you can imagine, politically, they are really frustrated with the fact that they have to pay that much. If you have to work and give away more than half of your paycheck to the federal government, that's a point of frustration, as you can imagine. All right, so here is the tax rates back in 2010. Having said that, these are way outdated. Taxes have actually gone up. I'm going to actually pull this up right now while you're looking at this. See, the highest bracket here is only 35%. So if you were in a state like Utah paying 5% on your state taxes and you made over $373,000, that would only be 40% of your total income that you had to pay in taxes. However, tax rates have gone up. So if you'll give me just a second, I'm going to give you an updated number on this. All right, so for 2015, if you made over $464,000, then you pay 39.6. 39.6. So that highest bracket, which is now 464,000 and above, is now at 39.6 instead of 35, right? So a difference in 5% for folks who make that much, which is pretty substantial when you think about it. 5% on that much money is a lot of money that they have to pay even more than they were before. Okay? And you might be one of those people who says, hey, if somebody makes that much money, then they should pay more. Those people would say it becomes a disincentive for them to be successful, right? So small business owners and entrepreneurs and people who make high incomes, they want to get as much of their money into things that don't create income as possible so that they don't have to pay taxes. So years ago, I don't know if you recall this, but when Mitt Romney was running for president, they looked at his taxes and said, hey, you didn't pay very much tax at all. Your actual tax rate is like 5% on the money that you have. Well, that's because most of his assets, they weren't income. He didn't have a lot of income. Most of his assets, most of his investments paid tax-free income, or he didn't sell them, so they didn't create income. And so there are ways for very wealthy people to basically shelter money from taxation. And back to your question, Michelle, it just has to do with whether or not you're currently making a high W-2 income or not. I recall back then that Obama paid more in taxes in 1 year than Mitt Romney did, which doesn't make any sense because Mitt Romney's a multi-millionaire and Obama's, he's worth a few million, but he's not filthy rich like Mitt is. But the difference is most of Obama's income was, W-2 income, that he's making, earned income as we'd call it, and most of Mitt's money is unearned income or passive income, and you can control taxation on passive income pretty dramatically. Okay. All right, so that's your tax rate schedule from 2010. Let's see. We have a marginal tax rate schedule on federal and state taxes, which means that for every category higher that you get into, you pay a higher percentage. So it's not that somebody who makes $500,000 pays 39.6% on all their earnings. for example, the first 100,000 they might pay 15, the next 50,000 they might pay 20, the next 50,000 they might pay 25. That's that progressive element to the tax, right? And once you get over 400,000 at this point, or 450 in this case, then you'd be paying 39.6 on every dollar above that amount. Okay, so it's important to understand that, because marginal tax rates are very different than what some politicians are talking about right now. They're talking about flat taxes, okay, which would mean that there's no marginal rate associated with how much you make. No matter how much you make, you just pay a flat percentage. So people who make more money pay more tax. People who make less money pay less tax. As far as the dollar amount, but the percentage is the same for everybody. Okay, does that make sense? So a difference between a flat tax and a progressive tax is pretty substantial, because under a flat tax system, the more money you make doesn't change the percentage that you pay. All it does is mean that, you know, everybody's paying the same percentage, so the more you make, the more dollars, you know, the dollars that you pay, but it's not a different percentage. Okay, gives you some examples, gives you some different things that you have to do. There are different types of income that you pay different kinds of taxes on. You see how I'm going through slides very, very fast. I apologize. Not something that's terribly important that we go over all the nitty-gritty details on. You'll find it all in Chapter 3. Then you have taxes associated with investment gains, and these are called capital gains. We talked about this in Finance 443, but if you're under a year, you pay short-term capital gains, which is taxed at your income tax rate. If you're over 12 months with whatever you're holding before you sell it, as far as different kinds of investments, then you would be taxed at 15% is all. Now, since this slide came out, and starting just last year, the very wealthiest of Americans are now taxed at 20% on capital gains. The middle class is taxed at 15%, and what the government considers to be poor are still taxed at 0% as far as capital gains is concerned. So this chart's changed a little bit as well as far as taxes are concerned. But the basic idea is right, which is if you get long-term capital gains on your investments, you'll be taxed at a much lower rate than if you have short-term capital gains or income. Okay, so it's more efficient to hold investments longer from a tax planning standpoint. Okay. All right, any questions on taxes? That's all we're going to cover on taxes. We're going to skip on to Chapter 4 about money management, reserve accounts, emergency funds, short-term liquid savings, those kinds of things. But any other questions about taxes before we move on? Okay, Michelle, Jack, did I put you to sleep yet? Are you doing okay? March Madness doesn't start till Thursday, so okay, good. All right. So let's skip over to the other slides. All right. Everybody see Chapter 4, Managing Your Cash and Savings? Okay, good. No technical difficulties tonight on the slides. That's good. Michelle, I have to always have you come to these courses because you're the person that is my person who watches out for the fact that sometimes I don't move the slides right. Appreciate that. I probably need to give you some extra credit at the end of the class for being the one to always point that out for me. At least you did in 443. I think we were okay last week. Hey, someone's got to do it. Good work. Appreciate it. Okay, so we've got a couple things we want to figure out as far as cash management. When we talk about cash management in financial planning, there are a lot of different reasons why you potentially need cash. Okay, a lot of different things. Basically, and obviously, you need cash from a day-to-day standpoint just to take care of day-to-day cash flow, right? So you and I as a household, we got to make sure we always have cash in order to pay bills, in order to pay for things that come up, in order to buy food, in order to pay utilities, pay rent, those kinds of things. Obviously, if we mismanage our cash, between paychecks or between times that we get some money, that creates a problem, right? The same thing is true for businesses, but we're not talking about corporate finance. On the personal finance side, It's just important to always have sufficient, right, for the needs that we're going to have during that period. Now, I realize that for many of you, and I'm not necessarily talking to you, Jack, or you, Michelle, but many of you who might be listening to this or listening to the recording later, you're at a stage in your life right now where you're going to school, you're working, you've got a family, and basically you're just trying to make it from paycheck to paycheck, right? You basically are just trying to balance and juggle everything so that you can get from one paycheck to the next, and you don't really have the ability at this point to save a lot or to invest anything. That might be the reason that you're going to school, right? It might be one of the reasons that you're going to school is to get a better job and to create some flexibility and additional savings and investing money for you, in the future, or pay down debts or buy a home, those kinds of things. So many of you have significant financial goals, but you can't really accomplish them yet. You have to wait till you get your degree and maybe, get a better job. So I understand that. So this doesn't apply to everyone. But in a normal situation, okay, where you're not trying to balance all the things that maybe some of you are trying to balance, in a normal situation, we're trying to take some of our income each month, right, and create a reserve account or some liquidity just in case a car breaks down, or just in case someone has a health scare, or just in case something comes up where we need to buy a different vehicle. Okay, these are all things that take substantial money sometimes, and so we want to build up our reserves or liquid assets so that we can accomplish those things without having to go into debt, right, for the whole thing. Yeah, so need a new roof, right? Most of us don't have $5,000, $7,000, $9,000 sitting around for a new roof, unless we've done a good job saving, and if we haven't, then that'll probably become a new debt for us to make payments on, right? So the idea of cash management when it comes to personal financial planning is to try to get ahead of those things as opposed to play from behind. What do I mean by playing from behind? It means that when anything comes up, we end up having to use debt for it. We end up having to make payments for a long time on it and pay someone else interest. Instead of doing that, at some point we want to get to a point where we can save some every month so that when we need the next car, when we need the roof, when we need a water heater, when we need to fix the car, when we have a health insurance problem, when all those things happen, we've got a reserve account that's earmarked for things like that and doesn't require us to go into debt. Okay? And then we always are continually adding to that cash reserve account, right? So we talked about earlier how you might have 3 to 12 months worth of expenses as a target for this emergency fund. But even if you already have 12 months worth of expenses, you will continue to make some kind of automatic contribution to that reserve account. And the reason for that is because once you're in a pattern or system of doing that, you want to always continue to do it. Okay? You want to always continue to do it. Why? Because it's a lot harder to stop and start than it is to just keep it going. Because you can always take a portion of your liquid savings and go, put it into an IRA or go invest it, right, for the long term. But it's a lot harder if you haven't done it for a long time to start some kind of automatic savings program when, your budget kind of from month to month has gotten used to not having that. It's a lot harder to restart. Okay? So I encourage clients to start some kind of automatic savings program, as small or as large as they possibly can on a month-to-month basis. Put it somewhere where it's off limits to your monthly spending. It's not commingled with your checking account where you're taking money out of all the time, or even, ideally even at your same bank. If it's somewhere else, it's a little bit more out of sight, out of mind for you. And then automatically contribute to it every time you get paid. As much as 10% is a good rule of thumb. And then don't touch it unless you truly have an emergency. Okay? Truly have something that takes a lump sum of cash, as opposed to just, we want to take a trip to Vegas, so we're going to use our slush fund. No, that would be a vacation account, right, that you have to save for separately. So once you can get in that system, though, of getting that reserve built up, then when something comes up, then you're able to use cash, and you're much further ahead as far as your finances are concerned than if you have to go into debt every single time something comes up. Okay? And I think all of us know this. We all know in practice that that's what we should do. What becomes the challenge is actually disciplining ourselves enough to do it. So if I'm going to school and I'm working and I have a family and I've got a lot of expenses and I feel like, hey, I got to wait until I have a better job before I do this, I would encourage you to consider, even if it's really small, starting something. Okay, every bank will allow you to do an automatic transfer program and set up an account for you for free. Okay, or should do that, right? So if they don't, go to a different bank, because there are banks that will do it for free. And what you can do is, if I get paid, let's say every 2 weeks I get paid $500. Well, every 2 weeks I can put, $10, $20, just something, nothing crazy, but every 2 weeks I could have that transferred automatically over into my savings account. And I know it sounds like it would take forever to get some money together, but you'd be surprised how fast you get a nice little reserve account there that can help you out if you were to get in a bind, or just need a few extra bucks, in an emergency. So no matter how strapped you feel, no matter how cash poor you feel, this is an opportunity, at some amount to get some kind of cash management started. Okay. So what kinds of things can you use to do cash management or have liquid, which just means it's available to you? Well, of course, you could just have cash under your mattress, but we've talked about some of the risks with cash under your mattress, right? Can get stolen, can burn, can be forgotten, loses its value over time because of inflation. So there's all kinds of things that cash can be a liability to you for. You can have it in a checking account or savings account, money market account. There are different kinds of money market accounts, most of which don't pay very much right now because interest rates are so low. You've got CDs, once again, T-bills, savings bonds. All these different instruments pay very low interest right now because rates are so low, but at least they pay us something. And so if you're considering having it somewhere, you might as well have it getting something, which is better than cash, getting nothing. Okay, and these are all liquid instruments that we can get at a moment's notice and cash out if we need to, so that we can go do what we have to do with those dollars. Okay. Let's see here. Got all kinds of different depository institutions. You're all familiar with FDIC, which is the insurance for bank accounts up to $250,000. Then you've got the NCUA, which is basically the same type of idea for credit unions. Okay, so don't get hung up on that. Credit union NCUA coverage is very, very good, just as good for all intents and purposes as FDIC. Okay, so either way, if you're under $250,000, you're well protected and government backed. Okay, all right, we better get to the test material, but any questions about liquid savings or cash management? There's a lot more material, obviously, in Chapter 4 than what we covered. You'll need to get into it a little bit more in order to, be ready for the assignment and the information that you'll need for the assignment, but that's all we have time for this evening. Okay. So because we have 50 problems on the test, this will take us a little bit longer than normal. I'm going to try to whip through it as fast as I can. Even though I'm going fast, though, you're welcome to put a question in on the chat board. I'm happy to consider it while I'm going through. Every once in a while, you'll hear a repeat question because this is a comprehensive midterm. It's got the week 1, 2 chapters, and then most of the material is from chapters 3 and 4. Okay. All right. Number 1 on the test, you just need to know or understand what the definition of market risk is. So number 1 on the test, you just need to know what the definition of market risk. Number 2 on the test, you'll need to understand this is a repeat question from week 1, but we want to know what capital appreciation is and how that differs from income or interest. Remember, if we have 2 different objectives, main categories of objectives when it comes to investing, we can either want income, or we can want growth, or we can want some kind of combination of both. But if we talk about capital appreciation, we're talking about growth. If we talk about dividends, we're talking about current income. So those are different, right? So just keep that in mind for the test. Number 3 on the test is the concept of compounding interest. Just make sure you understand what compounding interest is. Number 4 on the test. Number 4 on the test is once again talking about total return and the components of total return. You'll recall that total return involves both capital appreciation and income, not just one or the other. Okay, so keep that in mind for number 4 on the test. Number 5 on the test, want to know the definition of the desired rate of return and expected rate of return. Okay, desired rate of return and expected rate of return, and how those two what is the correlation between desired rate of return and expected rate of return? This is a repeat question from last week. Pretty straightforward when you think about it, pretty logical. but you might want to just review that from chapter 3, I think it was, or chapter 4, or excuse me, 13 or 12 or 13 from last week before you get to the test. Number 6 on the test is, once again, how do you define total return? What are its components? Number 7 on the test is a risk-free rate of return. How do we measure the risk-free rate of return usually when doing calculations for expected return? What is usually used as the risk-free rate of return? So just make sure you know what that is before you get to the test. Make sure you understand what's known as residual owners. You'll recall we talked about bondholders and stockholders in week 1. Which one of those is considered the residual owner? It's a repeat question from week 1 as well. Another repeat question on number 9, talking about how the price of an investment correlates to the yield of an investment. You recall if the price of investment goes up, the yield goes down. If the price of the investment goes down, the yield goes up. Okay? Because the percentage is going to stay the same as far as how much they pay out as on dividends. Okay, the amount that they pay out in dividends. But if the price is higher, then the effective yield is lower as far as that distribution, that dividend. And if the price is lower, then that effective yield is higher as far as that distribution for the dividend. So keep that in mind for number 9. Number 10 is talking about the priority of bondholders versus stockholders, dividends and interest. Just make sure you know who has priority as far as income is concerned. Number 11 is that question from week 1 about qualified investors. Qualified investors are a tier of investors that make a certain amount of money or are worth a certain amount of money. They either have a certain net worth or a certain income, and it's a pretty high threshold. And qualified investors are able to do things like hedge funds and private equity, where your average investor can't. But your average investor can do stocks, bonds, all kinds of different investments. It's just that there are a few investments that are reserved for folks who have more money. Okay, and those folks are referred to as qualified investors. So keep that in mind before you get to the test. Number 11. Number 12, make sure you know what a stock dividend is. Remember we talked about how there's a cash dividend and a stock dividend. What are the differences between those two and how are they taxed? Okay, cash dividends versus stock dividends. That's number 12 and 13. Those are repeat questions from last week. Make sure you understand the relationship between bond prices and interest rates. You recall last week that we talked about how they move in opposite directions. If interest rates go up, bond prices go down. If bond prices go down, interest rates are going up if bond prices are going down. Okay? And remember we talked about how that's really important in today's environment because for the last 30 years, interest rates have done nothing but go down. And now we're in an environment where over the upcoming years, interest rates will probably go up. So what does that mean? It means that bonds have done very well as far as the prices of bonds over the past 30 years because interest rates have been going down. And over the next 30 years, if interest rates were to just pattern up or their trajectory was up, bonds would struggle. So if you're a bond investor right now, you have to be careful about that. Make sure you're diversified. Make sure you're in bond instruments that don't get impacted like that. Look at history and make sure that you're careful about how you invest in bonds in a rising interest rate environment because normally, as rates rise, bond prices go down. Okay, that's number 14 on the test, that relationship between bond prices and interest rates. Number 15, number 16, and number 17 are repeat kind of math problems. And they're talking about, one's a yield question, one's a stock price question, and one is a percentage capital gain question. Okay, so between those three, you'll want to be able to do those basic math problems like you needed to know on week 1. Okay, pretty straightforward though. It's not like they're really highly complicated. They'll give you 2 or 3 inputs, and you're putting them into a very simple equation to get to the answer. Okay. Number 18 is asking about that difference in yield and price. Again, price goes up, yield goes down. Price goes down, yield goes up. Okay, if you know that relationship, you'll get number 18 right, which is a repeat question from earlier on in the test, just asked a different way. Number 19, just you'll need, if you know what a common stock is, then you'll get number 19 right on the test. Number 20 is a stock dividend question. Company's going to pay a percentage in stock dividends. It's a repeat question. And what does that mean as far as how many shares they're going to give out, okay, when it comes to stock dividends? Number 21 just asks you what the most common frequency of dividends are from stocks, and we talked about it last week. What's the most common frequency when it comes to dividend payments? You'll be in good shape there. Number 22 is the book value question. You'll need to know the basic inputs of a book value question. Number 23, so number 22 and 23 are both book value problems. They give you liabilities, they give you preferred stock, they give you common stock, and then they give you assets. And if you know those four numbers, then you can always calculate the book value. So I just have the book value formula just jotted down somewhere so that we can easily get those done when you get to those on the test. Number 24 on the test, you'll want to know what return on equity is. What is return on equity? Or ROE, okay? There's ROI, which is return on investment, right? When we talk about different investments, usually in the sense of corporate finance. When we talk about ROE, return on equity, we're talking about you and I as investment investors, what's our return over time investing in that stock. Number 25, we talked about PE ratios last week. This is a repeat question from last week about price earnings ratios. So what do price earnings ratios tell us? Whether or not they're high or low, what does that tell us? Okay. Number 26 on the test is a question about closed-end funds. This should be a question that based on your assignment from last week should be one that you can answer. Just some basics about closed-end mutual funds. What are they? How do they work? You'll get number 26 on the test right. Number 27. Number 27 is basically how mutual funds work. So you just want to know the basics of how a mutual fund works. The basic tenets of mutual fund investing are 1, diversification, 2, professional management, 3, economies of scale that you can get into it at lower amounts and be highly diversified. But that professional management means that you're not managing what happens inside of that mutual fund. A manager is, right? That's the whole point. I'll just keep that in mind for number 27 on the test, and you'll get that right. Number 28 on the test, okay, 28 on the test, you'll want to understand, well, if you know the differences and similarities between open-end mutual funds and closed-end mutual funds, and then ETFs, exchange-traded funds, and exchange-traded mutual funds. If you know what those are basically and the differences between those, you'll be in great shape for number 28 on the test. Number 29 on the test has to do with fees and closed-end funds. So make sure you know the basics about fees and how fees are assessed on closed-end funds. Open-end funds, or what we refer to as mutual funds, right? Open-end mutual funds. We want to know, once again, what those basic tenets of a mutual fund are. And I just listed them. You know, professional management, diversification, and economies of scale. If you understand what those three are, what they mean, why they're important, you'll get another one right on the test this coming week. Number 31 on the test, you'll just want to know the synonyms for open-end investment companies. Okay, open-end investment companies. What's a synonym for that? In the reading this week, you'll see that. Actually, you'll see it in last week's material. Number 32 on the test, we want to know what, on a mutual fund, the current price is referred to as. What is the current price on a mutual fund referred to as? That'll get you number 32 on the test right. Number 33. Number 33 gives you a list of different reasons why if somebody might do a mutual fund, you'll need to identify the ones that the book tells you are the reasons why people do investments in mutual funds. I've listed 3 that I think are the most important. Just make sure you understand what the book has to say about it so that when you get to the test, you can answer what the book has to say about it, which there'll be a high amount of crossover, obviously, in what I've just stated about the importance of why we do mutual funds. but you'll want to know how they word it so that number 33 on the test will be easy. Number 34 on the test, you're going to want to know what type of fund has a main objective to just follow whatever the market does. Okay, what type of fund is just trying to follow whatever the market does? Number 35, you're going to want to know the different types of funds. So there's growth funds, sector funds, money market funds, balanced funds, equity income funds. So there's different kinds of funds, different kinds of mutual funds, different categories that they assign different mutual funds to. You're going to want to know basically what those mean. Why do we categorize them? What do their categories mean? There's not that many, Michelle. Basically, when it comes to mutual funds, you don't have a ton, but you'll want to know some of the basic ones before you get to the test. I've just listed off the ones that are on the test question, by the way, Michelle, so you don't need to know all of them. If you know the ones I just mentioned, that will get you to the right answer on number 35 on the test. Number 36 on the test is finally about tonight's material that we covered from the chapters. You'll want to know the difference between progressive and regressive taxes. We talked about examples of progressive taxes and regressive taxes. You'll want to know the difference between tax avoidance and tax evasion, although that'll be something you'll be very clear on after the discussion board this week, but just make sure you're clear on avoidance and evasion. Which one's legal, which one's not, what is the difference? Number 38 on the test is a question of marginal versus average tax rate. You'll recall that we talked about a marginal tax rate and average tax rate, or flat tax, excuse me, and we talked about how flat taxes would just be the same percentage no matter how much you made. On a marginal tax rate, for every additional dollar beyond certain thresholds, you pay a higher rate, right? Which would increase your average tax rate overall, the more that you paid in higher brackets. However, your average tax rate is never as much as your marginal tax rate, right? Because your marginal tax rate is always going to be higher than your average tax rate, because you keep going into different tiers, which does increase your average, but your average isn't going to be the same as your marginal tax rate. So keep that in mind for number 38 on the test. Number 39 on the test, you're going to want to know where most of the revenue to the federal government comes from. So we talked about all these different taxes that are out there. Which one of those taxes that we referred to and talked about tonight creates the most revenue for the federal government? You're going to want to know that before you get to the test. Number 40 on the test, you're going to want to know what we call the pay amount before all your taxes and withholdings. So we have gross pay and net pay. Net pay is after tax, gross pay is before tax. Just keep that in mind before you get to the test. Number 41 on the test, you're going to want to know what kinds of things are included in your gross income and what kinds of things are excluded from your gross income. So another tax question, pretty straightforward though. What's included, what's excluded from gross income? You'll want to know the definition of tax liability. What's the definition of tax liability? It's pretty pretty logical. What is the definition of tax liability? Number 43, you're going to want to know basically what is meant by tax shifting strategies. Tax shifting strategies. And what are some examples of tax shifting strategies? Number 44 on the test, ask you a question about some of your cash management solutions that we talked about tonight. We talked about how there's checking, savings, cash, CDs, money market instruments, savings bonds, savings bills, T-bills, what we refer to those as the treasury bills. Anyway, you'll want to know which one of those pays higher, okay? And just a hint, the slide does it in order of who usually pays higher. Okay, so cash was listed first, right? That doesn't pay anything. Then it was checking accounts. They oftentimes don't pay anything, but sometimes they do. Then it was savings accounts. Then it was, if I remember right, CDs or money markets. Anyway, you go down that list, and it's basically in order by how much they pay. So if you know that and refer to that slide, you'll get number 44 on the test right, because it's asking you to compare them. You'll want to know what another name for savings deposits are or savings accounts are. The book points another name out, that's synonymous with a savings account. You'll want to know that for number 45 on the test. Number 46 on the test, you'll want to know the difference between rates of return on liquid investments versus ones that are not liquid, as a general rule. As a general rule, just so everybody knows, the longer term the investment, the higher the rate, right? And as a general rule, the shorter term the investment, the lower the rate. So it would stand to reason that your most liquid investment products that are on the lower end, short end side of the spectrum are going to pay less than your normal investment on the longer term end of the spectrum that aren't liquid, because in order for you and I to tie up our money, we want to get paid more. That makes sense, right? If we're not having to tie up our money, if it's just going to be perfectly liquid like cash, then we don't demand as much interest. Okay? So that's just a general rule. Longer the term, the less liquid it is, the more it's going to return. The more liquid it is, the shorter the term, the lower the interest rate. If you understand that concept for number 46, you've got one right. Number 47 on the test is an FDIC question. Okay, an FDIC question. Number 48 on the test is asking you to identify an account that does not pay interest. We talked about it tonight, but just read what Chapter 4 has to say is about difference between interest-bearing accounts and non-interest-bearing accounts. Number 49 on the test, you just need to know what a NOW account is. N-O-W account, a NOW account. What does the book have to say about what a NOW account is? You'll get that one right. And number 50 on the test is just asking you to understand what we've already explained, which is shorter the maturity or shorter the product that you're buying is, the lower the interest. The higher or longer term the product is, the higher the interest, right? So lower term, shorter term equals shorter interest. Longer term equals higher interest. Okay, that felt like a long review, but you've got some different notes on things that you should expect for this week's test. There was a lot of review material from the chapters from last week, as well as some new material this week about taxes and liquid cash management options. But any questions before we wrap up tonight? Okay. Have a great evening. Have a great week. Let me know if you get stuck or have any questions, and we'll get back to you as fast as we can with some answers. And just good luck this week. Have a good one. Keep up the good work to most of you who did a great job last week. Thanks, Jack. Thanks, Michelle. Yeah, you too.